as to what's been happening in the marketplace. But then I think in the last couple of weeks, there's been some jitters, because obviously I think for some of us, when we're investing in maybe technology stocks, there's been somewhat of a concern, right? For some of us who've invested in SpaceX in the beginning, it was great, and now it's become a bit more of a roller coaster. Or more recently, investing in some of the other tech stocks, the stock market movements have had some concerns, I would say, for people who are wondering, what should we do? But I think for all of us, a very important aspect and some of the things that we want to try to emphasize is that investing is for the long term, right? We want to focus and emphasize on some of the great opportunities that the markets have to offer. Because the fact is, when it comes to investing, it's not just about investing in stocks or bonds or commodities. There's a lot of things that we need to be comfortable about when we talk to clients. And this is what I'm here today. I want to provide and inject some confidence in all of you so that after today's talk and after the conference, you can then go back and talk to your clients about some of the great benefits that the markets has to provide when it comes to investing. So let me very quickly now start off with my presentation. If we look at basically the first 6.5 months of 2026 so far, performance has actually been fairly good. If you would have invested in a number of different Asian markets, like Korea, Taiwan, you will have a very good start to 2026. Obviously, we know there's been a lot of tension in the Middle East, and as a result, investing in oil has also been a very good part in terms of investing. But of course, investing, there are certainly some ups and downs. So even though I was showing everybody, I'm showing you that Korea and Taiwan has been one of the best performing markets, this month in July, Korea markets have been down a little bit over 20%. The fact is there are corrections and there will be ups and downs in the marketplace. But the fact is that if you look at the chart so far, what we should be telling clients and injecting confidence to clients is that generally speaking, the markets are in a fairly healthy position. And of course, when we talk about economic growth, the fact is that the economic growth right now is actually pretty good, especially when we look at places here in Asia. What I'm showing you right now up on the table here is if you look at the economic growth for the various different countries here in Asia, we're heading in the right direction, right? Everything is in a very positive direction, especially when we look at places like Taiwan, Vietnam, India, where they're looking and expecting to see well north of 6% when it comes to economic growth for this year. Even here in the Philippines, we're still expecting to see maybe not as high of an economic growth, but still growth to be anywhere between 3 to 4%. So generally speaking, economic growth is not too bad, but obviously that is, again, also not the main story. Because why? There's a couple of things here. When we look at across the world, there's a number of things that the various governments are doing today. And basically what they're trying to do is they're trying to help stimulate their economy to make things go even better. We have, if you look at the chart, we have look at this table here. We have Germany, we have the EU, we have China, India, Japan, the US, as some examples in terms of what each of the respective governments are doing. So even though I mentioned earlier that the economic growth was fairly decent, it's also comforting to know that the various central governments around the world are also helping to really help stimulate the economy. So these are all important aspects when it comes to investing. Because for us, as investors, and how do we inject confidence into our clients, is that not only are the markets and market participants, investors, confident in the markets, but the governments are also helping to support the overall economic growth. This is very important, because if you don't have governments around the world helping support the markets and helping support the economic growth, there are then obviously some questions and concerns as to how sustainable these gains in the markets can be. So this is obviously a very good positive sign. And of course, we know that the tension in the Middle East hasn't been helping. Okay? It hasn't been helping any of us around the world, especially with high oil prices. The fact is that when we talk about the confrontation in between the US as well as Iran, the fact is that oil prices and high oil prices are here to stay. Now, I'm no fortune teller. Okay? I don't have a crystal ball to tell you exactly where oil prices are going to be at the end of the year. But in all likelihood, oil prices are still going to be about 90 to 100 US dollars for the remainder of the year. Even if we get, let's say, an agreement that would be signed tomorrow, we're still going to have high oil prices for the foreseeable future. Why? Because the fact is that the overall supply of oil for a lot of countries are dwindling, right? There isn't a lot of excess supply. And so as a result, this is going to lead to a sustainable high oil prices. So this is also one of the reasons why a lot of governments are doing more than normal, because they too are concerned that the higher inflation and potentially a little bit slower in economic growth during the second half of the year could dampen the overall economy and the sentiment of investment. And so as a result, this is why you're expecting to see more support from the markets as well as the government for at least the remainder of this year. Now, back in March, when we saw the tensions first started, we saw a lot of different equity markets having a bit of a correction, right? When the war first escalated, March was not a good month when it comes to investing. In particular, if you invested in Asia, Pacific, ex-Japan stock markets, in March alone, your portfolio would have dropped 13%. Even when you're investing in the US, where people think, it's quite safe, the fact was that US equity markets fell about 5% during March. Now, why am I telling you all this of what happened back in March? Because it's also very important to understand that we get conflicts all the time. And I put up here on the screen, you can see that over the last 50, 60 plus years, we've had so many different conflicts. But the result, and basically what I wanted to highlight, is that once we get to 6 months, 9 months, a year after the start of the conflict, generally speaking, markets tend to forget what's been happening, and basically things start to end up back into the positive territory again. So why am I showing you this? Because the fact is that despite all the various tensions that goes on in today's world with geopolitics, the fact is that stock markets do not perform in the same way as what people's rationales are thinking about. Generally speaking, in the first week, in the first month of confrontations, yes, there will be some shortness in terms of sentiment. But generally speaking, 6 months, 9 months, a year later, investors aren't going to care much about what's happening in terms of some of these conflicts which are happening. So this is also something that you should really emphasize when you're talking to your clients. Because we know for a fact that historically speaking, tensions will constantly continue to happen. And we should not let the noise impact our decisions in terms of whether or not we should actually invest in stock markets. Now, this is what I meant earlier when I said that markets at the moment are too optimistic about oil prices. The fact is that any time when there seems to be a ceasefire, the belief is that, oil prices are going to drop and they're going to remain at low levels. But that's not the likely outcome. Our belief actually is that oil prices are going to be here in terms of long or high oil prices for at least for the foreseeable future. So this is something that we all will have to adjust to. And this is something that I know in the short term will have some implications which could impact in terms of our everyday lives. But ultimately speaking, we have seen time and time again how people are able to adjust. Now, when it comes to oil, I think the one thing that people also sometimes mistaken is the fact that when you look at the largest oil producers, the biggest one right now is the US. So the US actually have a lot to gain or to lose when it comes to oil prices. So this is why we're seeing a lot of tensions going on, and in particular, why oil prices are the way they are, right? Again, in the moving world in the more complicated world that we live in today, there aren't going to be, unfortunately, some of these tensions that are going on. But how does this actually impact us here in Asia? Because here in Asia, there's going to be some countries which are going to be much more impacted when it comes to high oil prices. And then there's going to be some countries which might not be as impacted. So of course, we all want to be the green here because the green here is basically the shock absorbent. They're not really, these countries are not specifically too exposed or specifically have a huge impact. And of course, the company or the countries that are red here are going to be those ones which are going to be the most vulnerable. So unfortunately, here in the Philippines, in Thailand, Indonesia, as well as India, these countries in particular do have a bigger impact when it comes to higher oil prices. Then in places like Korea, Japan, and Taiwan, there is a fairly big impact, but there is a bit of a cushion. And then of course, in places like Malaysia, Singapore, China, and Australia, these countries tend to be a bit more shock absorber in terms of not being impacted as much from higher oil prices. So there are things that we do have to think about when it comes to investing. As an investor, when we see that inflation is higher or input prices is higher, then we need to think about how do we position our portfolios when it comes to investing. And specifically when we talk about oil prices, and when we talk about, in terms about talking to households, there's a few things here, right? Anytime when we have fuel price increases, this is going to be the overall impact on the various markets. So you can see that, generally speaking, a lot of countries are going to be impacted as a result of higher fuel prices. I just came back from the US, so I've been on the road for about the last 6 weeks. And in the US, everything's expensive. Right now, at the moment, inflation is really picking up. Gas prices in California, where I was for a couple weeks, it was at close to $6 a gallon. So it has had a very big impact on the overall consumer. The fact is here in Asia, because some of the countries do not help subsidize the high oil prices, households are going to be impacted to some extent. So unfortunately, when it comes to investing, this is also why we need to be very careful as to how we can actually adapt and also focus on specifically where things are, because this will be something that clients, investors, everyday citizens have to be wary of. And of course, when I look at a country like China, there is one bright spot out of all this, which is what? Alternative energy. And again, it doesn't have to be just only China. Alternative energy, when we talk about, renewables, when we talk about solar, when we talk about EVs, China's been a very big benefactor. But with that point, China is not going to be the only benefactor when it comes to specifically alternative energy. Because this is something, for a lot of countries, there should be a lot more investment in. So this, to us, when it comes to investing as well, we look for opportunities, because whether be it we're talking about wind, solar, whether we talk about nuclear fuels, natural gas, oil, and coal, what we see is that wind and solar and other renewables in places like China are going to become a much bigger portion of the overall energy consumption. I was in Shanghai this was about 2 months ago. And the fact is that the streets when you're in Shanghai now are much cleaner. Why is that? Because all the cars are EVs, right? There isn't that pollution that we would have seen just 5 years ago. So this is how countries have really evolved and changed. Now, when we talk about the impact of the war and high oil prices, basically what is the impact? So we did some analysis, and here we're showing you the impact on the US, the Eurozone, China, and Japan. Generally speaking, if we think about in the US, because of the tension in the Middle East, their economy is probably going to see roughly about a 0.3 to a 0.4% decline in their GDP. Eurozone is going to be a little bit higher. We expect the Eurozone to be roughly seeing their economy drop by about 0.6 to 0.7%. Result, we see a lot of European central banks, and specifically, a lot of European countries, and as a result, the ECB, the central bank in Europe, to basically have to hike interest rates more than expected. Why is that? Because Europe is a big importer of oil. And as a result, higher oil prices is going to lead to more of an impact in terms of the overall Eurozone economy. In China, as well as Japan, the impact will be a bit more variable. The impact should be roughly about 0.1 to about 0.2%. As a result, in places like China, we expect the economy to still grow by about 4.6%, while in Japan, we're still expecting to see the economy grow by about a little bit less than 1%. But the general overall consensus, with the exception of China, is that central banks are going to have to slightly raise interest rates. Now that might not always be a good thing or a bad thing. You just have to sometimes think about, kind of where we are today. Generally speaking, when interest rates goes up, that normally leads to companies maybe not willing to borrow as much. And also at the same time, when it comes to companies, whether or not they're willing to spend, that also have an impact. This is also one of the main reasons why, when we talk about technology stocks, why right now are we seeing a pullback? Even though, when we read this in the news and when we hear about from NVIDIA's chairman, Jensen Huang, he thinks that AI spend is going to increase, quite a bit over the next 3 to 4 years. But of course, if interest rates do start to go back up, that does have an impact in terms of ultimately how each of the companies are going to spend on AI. Now, obviously, I'm not at a TED Talk today. I'm not going to talk too much about technology, but the one thing we have to understand is that technology is part of all of our everyday lives. Right? AI today is very much part of our everyday lives. That's why it's going to be very important, when it comes to looking at the overall technology sector. We have to also emphasize and understand kind of what companies are going to do. So when people come and ask me over the last few weeks, with this recent market correction, what do we do? Right? And our belief and our sort of ideals are, when we think about the technology sector as a whole, we see plenty of opportunities, especially here in Asia. And we think that a lot of Asian companies, a lot of Asian technology companies, who are the key supply chains to a lot of the technology companies around the world, they're still going to see a lot of benefit. And I have a slide here, over in the next few slides here, to just give you an example as to why Asian companies are going to be very important. As we're investing, we're also going to give you examples as to why and how we can try to actually take advantage of the situations. But back to the US. Right? The US economy, as we know, is growing. But the fact is that its economic growth right now in the US is very much unbalanced. Inflation, to some extent, has gotten really out of hand. Right? I mentioned earlier about a $6 gas. I was at Starbucks this was last week when I was in the US. After the sales tax, and after having to put in a 15% tip as they turn the machine around and ask for a tip, a cup of coffee cost me $10 US. This is how inflation has become, has taken a very central point in the US. And the fact is that when we think about everything that's happening, economic growth in the US is still going to be about that 2%. But we're a bit more concerned during the second half of this year, because we're not too sure exactly what the US Fed is going to do. There's obviously, with higher inflation, all signs point to the fact that they should raise interest rates. But if you raise interest rates, what's going to happen? Because right now in the US, if for some of you following politics, we have the midterm elections coming up in November. That's to see whether or not the Senate and the Congress are actually going to still be in Republican control, or potentially the Democrats could take control of both the Congress as well as the Senate. And of course, the sticky inflation, which I mentioned earlier, does really justify the hike. But of course, the question then still is the Fed going to hike interest rates? So this is something to definitely think about, because from an investment standpoint, we're a little bit more concerned right now about everything that's been going on in the US. Now, we've been hearing a lot of talks, especially when it comes to capital expenditure and how companies are investing in AI, investing in technology. There's a couple of things here. Yes, companies are definitely investing more. But we also have to look at what are they investing more in. They're investing more in IT hardware, power, materials, and defense. But even though they're investing a lot more into these particular industries, overall consumer sentiment in the US has now been, I would say, weaker, and as weak as it's been as compared to the last couple of summers. One of the main reasons, obviously, the fact that energy prices are impacting, generally speaking, overall consumer sentiment. But with everything that's going on, the one thing I do want to highlight, especially when we talk about companies and it comes to investing, our focus is on earnings. Right? The one most common thing that investors all around the world focus on when we look at companies is earnings. Because why? If I can tell you what a stock was actually worth, how do we go about thinking, how do we invest in any companies? The key fundamental thing that we do is focusing on earnings. And if we look at earnings across a lot of these Asian countries, the fact is that it has justified why the markets have been so strong this year. You know the first chart I showed you earlier, where we saw a lot of equity markets this year haven't been up so far during the first 7 months of 2026 to be anywhere between 10, 20, and north of 50 to 80% in places like Korea and Taiwan. All of that is supported by very strong earnings growth that we can see. So this is a very key element here. And of course, the other thing that I get asked a lot, especially with how markets have performed during the first 6 months, the question then is this sustainable? Or, given the recent correction, is this another dot-com bubble? Back in the early 2000s, for some of you, who are old just like me, we know that that was a very tense time when you had all these dot-com companies that had no earnings growth, that had a huge amount of PE valuations and a lot of debt. At that time, there was a bubble, and the markets crashed, and it took quite a number of years to recover. But what's different this time around, and this is something that you should also provide more confidence when you talk to your clients, is that for a lot of technology stocks today, especially here in Asia, their share prices have gone up, but it's supported by earnings. We're seeing very strong earnings growth across the board. Right? In Korea, for instance, examples are, if you look at the memory chip maker, SK Hynix, right now for this year, they're expecting to see earnings grow well north of 100%. So if earnings are growing well north of 100%, there's absolutely no reason why share prices, especially at current valuations, should not be going as high as earnings. So this is a very important thing that you should take away when you talk to your clients, which is because valuations are very low, and also at the same time, earnings growth is very strong, that 2026 is not 2001. Okay, right now, the earnings growth and the strong rise in share prices, especially in technology stocks, are supported by the strong earnings that we're seeing. And if I look to the future, even though I said that I'm not a fortune teller, but if you look at some of the estimates that we're seeing for 2027, overall, technology stocks and their earnings are still going to see earnings grow by approximately 40 to 50%. So this is the key thing here, right? Because if earnings can still have a very meaningful growth, not just for this year, but also in 2027, then chances are, when the markets come back, there will be a very strong support for markets to continue to have a fairly strong 2027 as a result of a very strong earnings growth market. Now, I've said a lot about the positives about earnings, but of course our clients also need to see about the other side. There's always two sides to the coin, right? The positive side, obviously, is that earnings growth and low valuations do help support that stock markets should continue to do well into 2027. But of course, the negative aspect is, as I've been talking earlier, is interest rates. Right now, central banks around the world have turned from easing, so they're not lowering interest rates anymore. And in fact, chances are they're going to be raising interest rates. Regardless if this was the ECB in Europe the Fed in the US, or the various central banks here in Asia, chances are interest rates are now heading more upward than downwards. But the fact is that even if interest rates do go up, our belief and our base case right now is that it won't go up substantially. This is not 2024 yet. Back in 2024, we saw interest rates, 23 and 24 period, we saw a substantial rise in interest rates, which deterred stock markets. But if central banks around the world are only increasing interest rates by 0.25%, or some by 0.5%, this is nowhere near the magnitude and levels that we saw from a few years ago. So this is also why there is still a lot of optimism, because while interest rates are slightly on an uptrend, the fact is that the magnitude of this uptrend is definitely a lot lower than what we saw back in that 23 period. So I talked a lot about the US, I talked a lot about the world, but Asia is really the place to be when it comes to looking for growth. Okay? Generally speaking, as investors, and when we look at the world as a whole, we see a lot more opportunities when it comes to investing here in Asia. Asia is tremendous in terms of the different opportunity sets that each country has to provide. But if I look at the key fundamental, whether it be in earnings or whether it be in economic growth, Asia has some of the highest numbers as compared to other countries. So this chart here shows an example of global economic growth as compared to emerging markets, Africa, Middle East, EU, Latin, and then some of the other areas on the left-hand side comparing the larger countries. And generally speaking, what we want to focus on is the fact that Asian countries generally do have stronger economic growth. And of course, as a result, why are we seeing this strong, or let's put it this way, why are we seeing strong economic growth? Because Asia is very much the exporter of the world. Okay, it's not just China, it's India, it's Taiwan, it's Korea. A lot of Asian countries are exporting a number of various different things, right? Everybody has its own uniqueness when it comes to exports. And this is why Asia continues to be a very attractive place when it comes to investing. So this is a very key fundamental benefit that we see here in Asia. Now I'm going to give you an example. This is an example of the NVIDIA AI server. When we talk about AI servers and when we talk about technology, everybody just thinks about the US. Rightfully so, because the US has the Max 7, and everybody has already seen how well the Max 7 has performed. But did you know of the components that goes into NVIDIA AI server, 70% of the components are coming from Asia. So while everybody talks about how many more AI servers that the world needs, every single one AI server that's been created, 70% of these components are going to come from Asia, and as a result, a lot of Asian companies are going to continue to stand to benefit and seeing strong economic growth and earnings growth as a result. So as long as we continue to see this strong rise in AI spending, the biggest benefactor is not going to be the US tech companies. To the contrary, the biggest benefactor are going to be the Asian companies who keep supplying all these tools. You might ask, well, haven't Asian companies been doing this all along, supplying electronic products to a lot of products like a smartphone or a computer? Well, they have. We have to think about this. Previously, when they were supplying components for an iPhone, or a Samsung phone, or a computer, the margins that they charge on these components were much lower. But today, an NVIDIA AI server costs about $5 million US. So the amount of money that these Asian component suppliers are now able to charge are much higher. And this is also why earnings growth has grown quite significantly over the last couple of years as a result of the rise in AI. So earnings is actually doing very well, and we think that's going to continue to do well. And of course, the other thing that I highlighted, I keep alluding going back, is inflation. Is inflation tame? Are we focusing on inflation, or are we not focusing as much on inflation? Well, the long story is that central banks are looking very closely at where the respective inflation levels are going to be, because from China, Hong Kong, India, Indonesia, Japan, Korea, Malaysia, Philippines, Singapore, Taiwan, as well as Thailand, you can see that central banks have a number